Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE FinWiz powered by CNBC TV 18 Season 3. Today we are at the corporate office in Mumbai of Mahindra & Mahindra. Headquartered in Mumbai, the Mahindra Group has an operational presence in 20 key industries in over 100 countries, providing insightful and ingenious solutions right from IT, automobile, financial services to clean energy and business productivity. NSE FinWiz visited the office of Mahindra & Mahindra in Mumbai with the country's finest experts to advise and educate the young employees on investments and financial planning. And we're now joined by our two very special guests. We have Gajendra Kothari, who's the MD at Etika Wealth Management. Welcome to the show, Gajendra. And we have Hemant Rustagi, who's the CEO at Wise Invest Advisors. Welcome to the show, Hemant. Our core topic for today is credit cards and loans. Hemant, when we're talking about loans, there is something called a CIBIL score. Could you shed some more light on what that is? Why is it important?
Well, CIBIL score is very, very important because, whenever any institution you apply for a loan, they want to see your credit worthiness, whether you'll be able to actually repay the loan. How do you find out? This is what comes from CIBIL score. What CIBIL does is basically gathers information from all the institutions that you're dealing with. For example, if you have a credit card, how you have been making payment for your credit card is something which is reported to CIBIL. If you have taken any loan and how you have been repaying that loan, whether you're paying regularly or you're not paying regularly is something which is known to CIBIL. The information comes from there. What kind of loans have you taken? Have you taken only consumption loan or you're taking loans to buy some assets? Also comes to CIBIL. Based on these parameters, the CIBIL score is given. Between 300 to 900 is what the score is. Most of the banks or financial institutions that give you loan are comfortable giving loans to someone who has a score of 750 and above.
So will it make a difference if, for example, Gajendra, I know you don't have, but suppose he has a low score and if I have a high score, will the bank, besides being wanting to give me a loan, would they help me by giving me a loan at a lower interest rate, or does that not affect?
Yeah, obviously it makes a difference. Like I said, higher the score, the better it is for you. The institutions, the banks or NBFC from where you take a loan, they're very comfortable giving you a loan because they know that you are maintaining a high score, which means that you know you can take credit and you know how to service that credit.
Okay, that's important.
If we were to look at two people who want to take loan, someone who has a lower score, obviously, one, he may find it difficult to get a loan. And even if the loan is given, the rate of interest could be higher compared to someone who has a better score. So it is always advisable that even if you are taking a loan for the first time, you get your CIBIL score checked before you go to the bank. And it's very important to have one. Now, if you have not taken any loan, or you don't have a credit card, you'll be very happy saying, okay, look, I haven't done anything wrong, so my CIBIL score has to be very good. But you won't have any score at all because CIBIL will not get any information. So either you must have a credit card, use it very wisely, or you must have some loan. And if you service that well, you'll have a good score. So it's important to have CIBIL score, and also important to have a good score.
Okay, great. Let's talk about loans, Gajendra. So when you talk about loan, how do you decide what kind of loan do I take? What I mean is, today you get a loan for everything. You get a loan to buy an iPhone 6s also. But how do you decide whether, okay, I do want this loan, and that loan, I shouldn't be taking that loan because it's just going to it's not going to be beneficial instead. So how do you take that call?
Right. So there are basically three kinds of loans, a good loan and a normal loan or a bad loan. Okay. The good loan is basically nothing but you're buying an asset. It can be a loan for education, higher education, or it can be for buying a house. So that's a good loan. You're investing in something, and at some point of time, it will help you repay, whatever the loan is. The bad loan can be maybe you're buying a car actually. Now that can again be a good loan or a bad loan if you're using the car for your office purpose and to make you more productive. It's a good loan.
Right.
But if you're buying the car to take your girlfriend around, so it's a bad loan then. So, and the worst loan is in the form of credit cards. So nowadays with this, we see all e-commerce channels, kind of luring you to buy. So he says, you buy a jeans worth 800 rupees and you can pay in 8 easy installments, 100 rupees each for next 8 months. that's a bad loan. You know, they're charging you 3.5% per month on such kind of loans. So you should definitely stay away from
But what
those
if I
loans.
pay my credit card bills on time? Then there's no interest.
That can be a wonderful thing if you can. Of course, then the credit card business will shut down. They'll not be around. But as per historical figures, the people who pay loan on time are very tiny fraction of it actually. Okay. Most of the people actually carry forward the loans, and that is where they make their money. So if you're paying dot on time, you're utilizing the 45-day free credit period, nothing like it. But eventually what happens, I've seen that today people have 5-6 credit cards.
Yeah.
And somehow they miss the deadline, you know, and then you are charged that interest period. And one thing which people don't know is that if you have not cleared your outstanding loan in that period, the next installment or the next thing which you buy on credit card, you don't get the free credit period on that amount. Your interest starts charging from that day onwards.
Okay.
So that's something
important.
which 95% of the people don't know.
Hemant, this question is from Anisha Saluja. She says, which is a better payment option, via credit cards or via online payment wallets like Paytm, MobiKwik, etc., as both of them have their own benefits?
Many times we get attracted to these because we want to collect these points, and we end up buying something more than what we actually usually should be buying. So I think that is something should not be really very important. But in terms of payment mechanism, you know, the thing is, when you're actually, if you look at credit card, okay, it sometimes becomes difficult for you to control as to how much you're spending. When you look at the other option, you know how much have you actually put the money in. So you know, you kind of restrict your purchases to that. So I think that is a major difference, I would say, in terms of how much or what medium you should be using for buying.
Okay. This question is from Manaswini Goyal, and she says, what should be the criteria for determining the tenor of the loan to be taken? How do we decide how many years?
Right. Ideally, it should be as low as possible, but it doesn't happen because you have to look at your cash flows also. Because always remember, when the EMI chart is drawn out, for the good first 10 years, you are only paying interest actually. Very little portion of your principal goes out in servicing the loan. Only at the end of the loan, you are paying most of your principal. And normally people come to me to prepay the loan at the end of the tenure. Okay. When then I say it doesn't really matter, because then all you're returning is a principal. You know, I mean, you hardly charge any interest. So you might as well continue. But yes, if you have the wherewithal, try to pay off the loan in 10 years or 15 years, you know, as soon as possible. Then you'll save a lot more on interest actually.
You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. It's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. Today we're at the corporate office in Mumbai of Mahindra & Mahindra. I want to talk to you about real estate. We love it here. Now, the concern is that the prices are skyrocketing, but people still want to invest. They want to buy a house, so they take a loan. I get it. But you know, a lot of these projects are under construction, or the erection hasn't been completed, or it's half done. How do you decide whether you want to, how do you decide which project to invest in?
Well, to begin with, I totally agree with you. Real estate is something that everyone wants to buy. When it comes to buying a house, clearly you need to see what is the purpose of buying a house. If it is your first house that you're buying for your family, obviously that has to be given preference. But it's equally important to understand that along with that, you have other goals. You know, it could be your child education, could be for your savings, putting money aside for your own retirement, or any such goal could be which you want to achieve in short term, medium term, and long term. What happens sometimes is that when you commit too much money to buy a house, you don't have enough for rest of the other goals. So you start actually feeling the pinch of it as you go along, and you realize that you don't have the liquidity. Okay, so I think it's very important to understand. I am always for that you must have a house for yourself, but keep these factors in mind before you buy one. When it comes to buying, whether it should be under construction or a ready house, property. But I think you need to be very, very careful, because there are many instances that we have seen where people have bought, okay, because major attraction is the price. So obviously, because you get discounted price, you get better price. So many a times we are tempted to buy a house which is in under construction building. You clearly have to look at the reputation of the builder, what their track record has been. And if you are comfortable, then go for it. But ideally speaking, you should go for a house which is ready for possession.
It's easy to go that way.
Overall, for any product class, is it beneficial to buy it or lease it? For example, should I buy a car or, use a cab for my daily travels, or buy a house or live on rent?
Well, I think it's a very, very interesting question. Let me begin with the house. Okay, there is always a debate because as you mentioned in the beginning, that the prices are skyrocketing. Obviously, many people are finding it difficult to buy a house. And as we also mentioned that the rental yields are very low. So the temptation is that even if I'm staying in a house which is worth 1 crore, I'm just paying a rent of 25,000 rupees. It makes sense. Well, purely from financial angle, if you see, maybe it makes sense not to buy one, but there are other factors that you need to consider. There is something called providing security to your family. There is always a peer pressure from the family, right? And imagine what it does to your life, that every 11 months or 22 months you are changing your house. Once you have children, you may or may not get a house in the locality that you want. It could be away from your children's school, from your office. I think it kind of unsettles your life. It's always advisable to at least buy one. Now, many times we also think that since I'm buying only one time, why buy for 1 crore? Let me buy for 2 crore. Let me plan for 10 years from now. I think that's not the right strategy. Look at something which is reasonable for you. Plan to buy a house. Even if you can buy 2-bedroom hall, buy that. Begin that. You can always move into 3-bedroom later on. So it's always important. In terms of car, as you mentioned again, you need to look at purely from financial angle. Anything that you take on loan, obviously you have to pay interest on that. You also need to consider that what is the interest that you're paying and what are the investment options you have. Also, let me tell you, there is no guarantee that if you think that I will stay on rent or buy or take or use taxi for moving around and use that money for investment. Sure. I haven't come across many people who actually maintain that discipline. Now, what will happen is you will not buy a car, but also you will not invest your money. If you feel very confident about the fact that you are a disciplined investor, that you will actually, whatever money you're saving aside, keeping it aside, you will actually invest, by all means go for it. Consider what interest you're paying and what is that you want to do. So I think these are two factors that you need to keep in mind.
How do I choose the right financial advisor? So typically at the end of the year, I go to my CA for the tax planning part. And most of the time I'm told that the CA is as good as a financial planner. But I increasingly hear of personal financial advisors who will advise me better. So I want your opinion on this.
Very valid question. I think it's $1 million question. Most people struggle to get advice because I always believe that it's, choosing a financial advisor is like choosing a doctor. And how do you choose your doctor? So if you live in a locality or wherever, then there are two methods you use. One is trial and error. You go to one doctor, it works, then you go again and again. If it doesn't work, you change the doctor, right? So that's the first. The second is word of mouth. If in your circle, if somebody has been already using somebody's service and he has found it very professional and trustworthy, then you get that advantage that you don't become a guinea pig there. You've gone through the trusted source. That would work better. But nowadays, even the Google really helps. You can establish the credentials of the person to whom you're going. There is a lot of digital footprint now available. Nobody can fake it actually. So you can check what kind of qualifications he has, whether he's an independent advisor or an agent of a company, what kind of clients he serves. So some kind of these due diligence will help you figure it out. Now, of course, you will only come to know when you actually meet and use the service for 1 year or 2. But this can be a good starting point. Word of mouth really works in this industry.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. I have two very special guests with me, Gajendra Kothari and Hemant Rastagi. Let's talk about mutual funds and SIPs. Now, first, let's start with mutual funds. Now, there's a lot of confusion. People believe that mutual fund itself is an asset category, but that's not true. Mutual fund is a vehicle to invest, and you can invest in different asset classes through that. Could you shed some basic light on mutual funds and how do you select a good mutual fund?
Right. So, one question which I normally ask participants is that where all you've invested is, and the normal answer I get 20% in mutual funds, 20% in direct equities, 20% in gold, 20% in FDs and 20%. I said, why? He says, I want to diversify. I don't want to put all my eggs in one basket. That's a big myth, So many people think mutual fund is just a basket and I should only put 20%. Actually, as you rightly said, mutual fund is just a vehicle. Through mutual funds, you can actually invest in all asset classes. So you want equity, you can go to equity, gold, fixed income, real estate, commodities, currencies. Now in India, some of these are not available as of now, but shortly they will be introduced. So you can actually invest through mutual funds in any of these asset classes. Now, why to choose mutual fund to invest in all these asset classes? Two reasons. One, you're getting professional management. The person who is managing this money is a highly professional guy with a lot of team members who are only tracking your money. 24/7, their only job is to manage your money. That's the one reason. And second is the cost part. So if you were to do on your own, to choose from 5,000 companies to invest and put into stocks directly, you may go wrong, right? So that's where you get and when 500 people come and together pool the money, the cost is very low of hiring that person. So these are the two great advantages of managing, through mutual funds actually.
My idea of investment is getting a real return out of your investment. That is nothing but what I am getting over and above the inflation rate. There has been cases that RBI had issued WPI linked bonds and CPI linked bonds in the market, and today there was an auction also for getting it repurchased by the RBI, and RBI has not selected any bid for the same. So what, according to you, why these bonds have not really picked up and why investors are not very keen to go for inflation linked bonds?
Seasoned investor you are, man. You know all the terminology, man. Okay, Hemant, you want to take that?
Well, again, I think very, very interesting question. Before these bonds were introduced, okay, there was a lot of expectation from these bonds, and what was happening every time we were talking about earning real rate of return, everyone is giving option of equity, right? And not many people are comfortable investing in equity. So the expectation was that when you have these bonds, and when these bonds allow you to stay ahead of inflation, I think these bonds should really take off in a big way. The problem here is, again, what is that is being offered over and above inflation is the key factor there. And also, let's not forget that, let's say you're looking at a bond which is 7-year tenure. During the period when the inflation is low, people find it difficult to accept that return. The point is that when you're talking about beating inflation, if the inflation is 3%, then you should accept 5% as return. Then the person says, look, 5% I was getting in saving bank account, what is that I'm doing with my money? Okay, that's one of the reasons why you've not seen a lot of people investing in that. So what we talk about is, when is it important for you to get real rate of return? Okay, when you're investing for the long term. Okay, when you invest for the long term, the time horizon could be 10 years, 15 years, 20 years, or anything. But that's why, we come back to this earlier thing which I said is equity remains the best bet. And yes, equity is risky. We've seen equity being volatile from time and time. But there are two important things. One, you need to have a long-term view on your investment in equity. The second is you need to follow a disciplined approach. Many a times you will come across investors who will say, I've invested for 5 years, I've not made any money. The point is that if you're looking at point-to-point return, maybe you will see disappointment. But if you follow regular investment, disciplined investment, I'm not saying it has to be always through SIP. It could be that whenever you have long-term investment fund, you should kind of commit to equity. So keeping these factors in mind, equity still remains your best bet. And that's why you don't see that a lot of demand for these inflation index bonds.
In mutual fund, be it lump sum or SIP, dividend payout is the best option or a growth is the best option, and why?
Okay. Gajendra, you want to take that?
Yeah. So again, this is a confusion which most people have, which option. Today, unfortunately, what has happened today, mutual fund has become such a complicated product. It was never meant to be. It was meant to be for retail investors, but the industry has actually created so many different options, and the common investor is lost in these jargons. So just to give you the why should one go for dividend option and why should one go for growth? If you are a person who is expecting regular income from your investment every month to meet your financial requirements, then you may go out for dividend option, so that you can expect some amount coming every month, and that can be tax free or that can be taxable depending on the funds you choose. But if you are here to create wealth in the long term, then dividend option is not a good choice. Your money should be in the growth option where your money accumulates, and that's where the power of compounding kicks in, and your corpus keeps growing up. So for long term, if you want to create wealth, growth option. For regular income, dividend option is the best option.
Okay, on that note, thank you so much, Gajendra. Thank you, Hemant. And thank you so much for having us here with you.
This 1.5 hour has been really informative. These are questions that we often struggle with, but we often don't know who to go to and who would be able to address these questions effectively. So this 1.5 hour has been a great investment. It has helped me understand a lot of things that were just hoovering queries.
There is no one-stop shop kind of when it comes to investment, but it's different. and one has to customize as per his and her requirements. That was very insightful. Plus the credit cards, how do you work with the credit cards? How do you wisely invest in property? That was really very good.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But before we go, here's a chance for you to win a cool goodie bag by answering this viewer question. Which organization in India provides you with credit score and credit report? CIBIL, RBI, Income Tax Department. Send in your answers at fwq@network18online.com. The correct answer to last week's viewer question is option C, funds with long track record. Many thanks to all the viewers who sent in their replies. The winner to episode 11's viewer question are Chanchal Wankade and Naga Pradeek Avadhanam. We'll see you next time with another set of young employees at another company. Until then, from the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.